All right. Good afternoon, everyone, and welcome to the 8 Ways to Build Value in Your Business, presented by myself. I am a chartered accountant, as you all know, being clients and such of mine. And we're branching off into this value builder process to help our clients realize more from their businesses than perhaps they're getting at this point. Today's agenda is pretty simple. We're going to do the 8 drivers of business value with some examples. And this will be based on the value builder system, which was designed to help owners of businesses get the most out of their business when they go to exit the business. The system focuses on 8 drivers, all of which acquirers of businesses use to rate how much they are willing to pay for the business. Over the next hour or less, we will discuss the drivers and how they affect the value of a business. And we will finish off by taking a look at the yes box, which shows how some businesses started and thrived despite a recession. And like we said at the end, there's going to be an opportunity for questions and discussion, and we're not going to record that. I am a member of the Value Builder system, and I am a certified value builder. I'm going to start off today, though, by talking about Stephanie. Stephanie Breedlove started Breedlove and Associates after she realized how complicated it was to add a nanny to payroll. If Stephanie and her advisor had been focusing exclusively on manager metrics like revenue, sales, and profits, she would have sold for a modest multiple of profits. Instead, she was focused on owner metrics. We're going to talk about that as we go further on today. When Stephanie hit $30,000 a month in revenue, she quit her job at Accenture and devoted herself full-time to Breedlove and Associates. To grow, she had a choice: sell more to existing customers, busy couples who often needed lawn care, house cleaning, grocery, or stick with her niche and what she had really originally set up to do of just paying nannies. Most experts said it was much easier to sell more to existing customers, and they're right, but what is easy rarely makes your business more valuable. Breedlove decided to stick to her niche and find more parents who needed to pay their nanny, and doing so laid the foundation for a more valuable business. Stephanie knew she had a point of differentiation, and she kept working to grow her company. After 25 years, she built it up to $9 million in sales and had 10,000 customers. But after 25 years, Stephanie's kids had left the house and she wanted to do something else, and she decided to sell her business. Stephanie discovered a company called care.com, which gives you a list of 5-star rated nannies and babysitters in your local area after you've inputted your postal code or zip code. At the time, care.com had 7 million parents who were subscribers, and she went to care.com and said that all the 7 million subscribers used to need to pay their babysitter or their nanny, and that she could make it easy. She said, look, if 1% of your customers buy my payroll service, that's 70,000 customers. That's a business 7 times the size that we are today. And it's taken us 25 years to get to $9 million in revenue. You could get to $70 million in revenue virtually overnight, and that's only with 1% of your customers. Never mind what happens if you get to 2% of your customers. Ultimately, Stephanie sold her $9 million company for $54 million to care.com. Amazing multiple. So we're going to talk today about drivers of company value. These are the 8 drivers of company value on the screen. And we talked about monopoly control is basically what Stephanie worked with. Investors from Warren Buffett on down look for companies with a deep and wide competitive moat that gives you pricing authority. If you have a differentiated product or service, we call it having the monopoly control. In Stephanie's case, she was focused on her financial performance, but her primary goal was boosting the value of her business. So she also focused on the other 7 drivers. For example, had she differentiated and diversified herself at $300,000 in revenue, she would have improved her short-term financial performance, but undermined her score on the monopoly control. Monopoly control is a score, not a concept. Think of it like a cable package where you must buy a large package of channels, but you are really only interested in a couple of channels. At this point, I imagine you may be wondering if this program really works. We've studied more than 65,000 business owners who have used our system and found the average value builder score is 59. And those average businesses receive an acquisition offer of 3.5 times pre-tax profit. And as you can see by this chart, those businesses that achieve a score of 90 or more on average are getting offers of 7.1 times pre-tax profit, more than double the average performing business. So working on these 8 factors I'm going to talk about today, it's not just theory, it's a material impact on the value of your business. Not only that, it also has a material impact on the likelihood that you will get an offer to buy your company. Getting a score of 90 also means you are almost 3 times more likely to receive an unsolicited offer for your business. Now you may be saying, well, I don't want to sell, but getting unsolicited offers puts you in the catbird seat, right? You're in control. You can bat away the offers and say, not now, not interested, and watch them increase over time. Or you can choose to engage with an acquirer if you want, on your terms with leverage. That's the benefit of having a high value builder score, having people coming to you as opposed to you going hand in hand to them. There's nothing that gives you more control and more negotiating leverage than being scouted. I want to introduce the concept of the manager metric versus the owner's metric, because I think as a lot of us as managers, we make the mistake of thinking like managers. And I think the savviest entrepreneurs start thinking more like an owner. Here's an example of an income statement for a small business. The main numbers are the revenue number, the expense total, and of course, the bottom line profit that results. And let's start with how managers think. Let's think about how a typical manager becomes a manager. If you think about it, most managers went to school and they took business. They learned about the language of management, and then they worked for a company. And then as a manager in that company, if they rose through the ranks, they started to manage certain metrics, right? If you think about the profit and loss statement of a typical business, the sales manager focuses on the revenue. You might have an operations manager who focuses on operating expenses. You might have a general manager who focuses on net income and profit. All of these are manager metrics. It's the language of management we learn in business, and then we are managed and held accountable for those numbers as managers inside companies. But those are really just ingredients. Managers care about those numbers because their bonus is triggered by cheating them. But owners understand that something different, that they're really just ingredients in a meal. And the owner metric is that the meal makes the ingredients, and that the meal that they make is a meal, and that is the value of your company. Owners are focusing on the value of their company, not necessarily the ingredients that make the value. What they're really talking about is thinking more like an owner, less like a manager. Managers usually manage certain metrics such as profit and loss statements, revenue, net income, etc. Owners are focusing on the value of the company and not necessarily the ingredients that make up the value. So let's talk about value. A quick example here. The first example, at the risk of oversimplifying a complex science, valuation comes down to one calculation. What multiple of your profits is a buyer willing to pay? Let's take the hypothetical example of a company with $800,000 in pre-tax profit. The standard multiple in this example is 3.5. So the value of the company is 2.8 million. Now our system helps you increase the profits of your business by $100,000, which in turn increases the value of your business by $350,000 to 3.15 million. The value builder system focuses on increasing the multiple in the business. So the 800,000 in pre-tax profit in this example, increasing the multiple from 3.5 to 7.1 would increase the value from 2.8 million to 5.68 million. But what if we did both? This is where the customer really wins. The value of the company is almost 6.4 million, almost 2.3 times more valuable. The owner's metric is the value of your company, and that's where the savvy entrepreneurs like Stephanie Breedlove obsess. Your friends from school, your peers, even your family probably want you to grow your revenue at all costs, right? Because that's the way we judge companies. Bigger companies are more important. How many employees do you have? How much revenue do you have? That's the way we judge each other as entrepreneurs, and it's misguided. People like Stephanie know that they're going to get a whole lot more value by putting their head down and focusing on doing one thing for 25 years better than anyone else. Nobody cared much about Stephanie's company for the first 25 years. It was growing at a 5, 10, or 15% a year rate, but then she looked up and sold her company to care.com. She benefited from focusing on the value of her business, not just the revenue of her company. And that's really the owner's metric. And I want to really make sure you knew that and spend our time today on what drives the value of your company. So what drives the owner's metric? Working clockwise around the chart, we have your financial performance, which is revenue and profitability. We've talked about monopoly control and how well differentiated your business is. We haven't yet spoken about the Switzerland structure. The Switzerland structure gets its name from the country of Switzerland. Countries that have an independent structure have a strong Switzerland score. In other words, they're not dependent on a single customer, so they get good diversity among their customer base. And they're not overly relying on a single employee and not overly reliant on a single supplier, so they don't have platform risk. Those three elements make up the Switzerland structure. So you want to make sure you're independent of any of those constituencies. And it's called the Switzerland structure, of course, because Switzerland has been independent country for over 400 years. They didn't get involved in the world wars, even though it was going on all around them. And that's the reason for the name of Switzerland structure. But again, you want to have that in your company so that you're independent of any of the major customers, employees, or suppliers. The next driver that we're going to talk about is the hub and spoke model. Hub and spoke model is used by airlines to centralize their operations and coordinate flights between different cities. Airlines will typically have a couple of hub airports out of which all their flights are coordinated. What happens with one of those hubs becomes unable to operate. The last time I did this presentation, it was in January, and airports were being closed down because of weather, which really messed up the airlines at the time because their hubs were unable to operate. The whole system is seriously challenged and may even grind to a halt. This same driver is evaluated by the acquirer of a business from the point of view of how dependent the business is on one particular hub of activity. Usually that hub would be the owner, and if the business would collapse, if the owner were unexpectedly unable to work for a period of 3 months, the value of the business is much less if such a disturbance would not challenge the business. You see the average multiple in the data subset who received offers to these users in the Value Builder questionnaire was 3.76. But that varies dramatically based on how these business owners answered a very simple question, which is, tell me about the relationship you have with your customers. Business owners who say, I know each of my customers by first name, on the surface sounds like a good thing. While you may be delivering a great customer experience, if you knew all of your customers by first name, you probably have a very limited valuation because it means that your company is deeply dependent on you as the rainmaker for your business. Contrast that with those entrepreneurs who say, I don't really know any of my customers personally, and I rarely get involved in serving the individual customer. Those businesses are trading at almost double the value of the businesses where each know the customers by first name. Now we want to talk a little bit relating to this is called the owner's trap. The owner's trap is where you become heavily relied upon to sell and deliver your products and services. You may start out as the primary salesperson interacting with the customer directly. Because you are the main salesperson, you are able to satisfy any additional requests that the customer has due to your deep level of expertise in the business. This has easily pushed the business to offer too many products or services. This variety of offerings often becomes only deliverable through your direct involvement as the owner. When you are directly involved in the delivery of these products or services, then the customer becomes accustomed to interacting with you and starts to expect it. Some signs you've fallen into the owner's trap are the business slows down when you take a vacation, customers come to you with problems, your growth has reached a plateau. Not only are businesses stuck in the owner's trap stressful to run, they're also worth significantly less than they would be because few people are going to buy a company that is dependent on its owner. The secret to improving hub and spoke. Many business owners say yes when clients and customers ask, can you do an additional service or product or customization? This broadens the list of products and services they sell, which sounds good at first, but selling lots of things to few customers is a recipe for your business to become owner dependent because you are likely the only person in the company with enough industry knowledge to successfully deliver such a broad product or service line. The most valuable companies do the opposite, selling one or two things to lots of customers. The secret to scaling is to move away from scaling many things to a few customers towards selling less stuff to more people. How do you decide where to focus? That is the way to improve your score on the monopoly control and hub and spoke drivers. The next driver of business value is the customer score. Here I've got a little story about Fred Reicheld, who developed something called the Net Promoter Score, or the NPS. Reicheld was a consultant who has spent his career studying what leads customers to refer and repurchase. He wondered why companies with satisfied customers were not growing faster. Reicheld discovered that there was no predictive value between a customer saying they were satisfied and the likelihood that they will either repurchase or refer you. Reicheld developed a standard measure to benchmark companies on willingness to recommend that's used out by most Fortune 500 companies, including Apple, Intuit, FedEx, eBay, and Amazon. Reicheld got to work combing through the numbers and discovered one question which was predictive of both repurchase and referral. On a scale of 0 to 10, how likely are you to recommend us to a friend or colleague? Fred saw that this question was highly predictive that the customer would take one of two behaviors. Promoters, those who gave you 9 or 10 on a score, were much more likely to refer that business or likely to repurchase from that company. Research from 2011 to 2021 found that extraordinary performers on the Net Promoter Score saw their stock outperform the US stock market by nearly 3 times more value created. So we're going to talk about calculating the Net Promoter Score. To measure your NPS, survey a group of your customers, asking them the simple question, on a scale of 0 to 10, how likely are you to recommend us to a friend or colleague? Group your respondents into one of 3 categories. Promoters give you a score of 9 or 10, passives give you a score of 7 or 8, and detractors give you a score of 0 to 6. Those are people who will not recommend that others buy from you. Those people that give you a 9 or 10 are your promoters. Your passives are the people who give you the 7 or 8, and your detractors are people who give you a 0 to 6. To figure out the Net Promoter Score, take your percentage of promoters, in this hypothetical example, 25%, subtract your percentage of detractors, in this case, 5%, and you get your Net Promoter Score of 20%. Fred found that the average net NPS is 15%. It's highly predictive that your customers are going to repurchase from you and that they're going to refer you. That's why it's so important as a leading indicator of the value of your company. It's why a lot of acquirers and a lot of entrepreneurs have really adapted this methodology as a way to evaluate their business or the businesses that they're looking to buy. You'll be able to give them longitudinal data over many years, tracking and improving your net promoter score if you start measuring it now. The next driver that we're going to address today is growth potential. Why do people care about growth potential? Well, think of an acquirer for a second. For most entrepreneurs, we think of the end, the exit, as sort of the last mile of a marathon. You can just get willing your body across the finish line, but if you put yourself on the shoes of an acquirer, that's actually their start line. So they're going to buy your business for $1 million, 10 million, or 100 million. Doesn't matter, but that's their start line. What they want to know is that your company has legs, that it can grow quickly beyond what you've achieved. We're all looking in the rearview mirror as entrepreneurs. We want to be evaluated on what we've done in the past, how much profit we generate, how much revenue we generate, how many awards we've won, how many employees we've recruited, the locations we've built. All of these are past tense things. And while these are good and important things that acquirers look at, you're also going to want to know, how can I take this business from what I'm buying it for and make a return? For them, it's their starting line. They want to understand your growth potential. And one of the questions we ask in the Value Builder score to evaluate it is used as a way to ascertain and quantify your growth potential. No matter how much they have paid to acquire your business, they want to know how it can grow beyond what you have achieved and how they can make a return on their investment. So the question we ask here is, if you had 5 times more demand for your product or service, imagine you wake up in the morning and that's 5 times more customers who want to buy from you. How easy or difficult would it be for you to fulfill that demand? The average multiple that business owners get offered is 6.76 times the multiple. For businesses that say it would be impossible to accommodate 5 times more demand, such as a law firm, they received a much lower multiple, such as 2.94%, compared with those business owners that said it would be very easy to accommodate, such as a software or manufacturing company. They generate much better multiples of earnings. This is Rod. Rod Dury founded Aftermail in 2004 to provide a better way for companies to store old emails. Rod went and sold 2 contracts to 2 Fortune 500 companies, generating $2 million in revenue. Rod did not look for more companies to sell to, but instead went to look for the care.com of the industry and found Quest. Quest was a software reseller of sorts and had relationships with all of the Fortune 500 companies selling them software. Instead of competing with Quest, Rod brought up the idea for them to buy his company. After just 2 years in business, and despite only just creating $2 million in annual revenue, Aftermail was acquired by Quest for a reported $35 million. Rod made a case about his growth potential to the company Quest. Rod's company was more valuable in Quest's hand than it was in Rod's, which led them to make an outlandish offer. The last driver we're going to talk about today is the recurring revenue. When entrepreneurs think of recurring revenue, they think of software as a service companies, they think of media companies, and maybe membership websites. For most business owners, they think recurring revenue does not apply, as they have a retail business, manufacturing company, a distribution company, etc. I want to introduce you to a couple of guys who founded H. Bloom. H. Bloom started as a retail business of selling flowers when they decided to reimagine the business of selling flowers into a subscription company. People usually buy flowers for special occasions, but they realized that high-end hotels buy flowers at a regular cadence to make their patrons feel like they're in a fancy or special hotel. If you look at the average lifetime value of a flower store customer, typical transaction value of a customer that kind of walks in and buys a bouquet of flowers is $29. The average lifetime value of an H. Bloom subscriber is more like $4,500. One sale now generates more than $4,500 worth of revenue compared to $29. In comparison, a typical flower store throws out more than 60% of their inventory whereas H. Bloom only throws out 2%. They only purchase enough flowers to fill their subscription needs. Which company would you rather own? Which would you find less stressful? You may not have inventory or products that rot, but having employees is a form of inventory. Recurring revenue subscription helps to plan your resources effectively and makes your business more predictable to run, therefore more efficient, more profitable, and less stressful. So at this point, we've run through the 8 drivers of what acquirers are looking for, and I want to just go through a few of the key takeaways from the presentation so far. Profit and revenue are important, but be an owner, not only a manager. Focus on selling less stuff to more people. Reduce reliance on any single customer, supplier, or employee. Be careful of the owner's trap. Know your net promoter score. Leave some field left to plow, and create recurring revenue streams. These are the things that we go through in the Value Builder program. I want to just talk about another quick concept called the yes box. We want to talk about how step change thinking is the key to growing sales, even in a shrinking economy. We've got 4 company logos on the screen here, and we want to talk about what these companies have in common. What they have in common is, in fact, they were all started in an economic downturn. Recessions can be brutal, but they can also be the spark that catalyzes innovation inside your business. Before we outline how to play offense in uncertain times, let's begin with a summary of where we're at. Some owners assume that in addition to preserving cash, the best way to outwit a recession is to lower prices to ensure they are the cheapest provider in their category. Lowering your prices can be tempting. As the recession digs in, consumers reach a tipping point and look for cheaper alternatives. The longer a downturn lasts, the stingier customers get. In the early days, consumers may tighten their belts while anticipating a reduction of cash flow, but unemployment usually lags the economy overall. Companies must experience lower demand, realize they have excess staff, and then go through the arduous process of deciding who to cut and how. It all takes time, which is why the unemployment rate is a lagging indicator of a recession. However, lowering your prices triggers a downward spiral of thinning gross margins, leaving you little room to invest in differentiating your business from its competitors. As competition heats up, margins get thinner. Businesses with little differentiation and tight margins is of little value to an acquirer. You may win the battle for short-term sales, but you will lose the war. What if you don't want to compete in a price war to the bottom or cower in the corner until things improve? What if you want to capitalize on challenging economic times? That requires an entirely new way of approaching your industry that we will call step change thinking. To understand step change thinking, let's first look at the opposite, incrementalism. In a world of continuous improvement, most products and services are positioned as incrementally better than their competitors. Rivals duke it out by making small changes to their offerings, giving one a slight lead for a few months before the others can catch it. Baby steps. By contrast, a step change improvement is something entirely different. A step change is when you take a large step forward all at once. Rather than small tweaks, you make a significant improvement over your existing competitors. To illustrate the concept of a step change improvement, let's go back to the early 2000s. In those days, if you were a well-paid executive catching a flight in the morning, you would likely have scheduled a car service to pick you up at an appointed time. 2 or 3 times the price of a taxi. These services were expensive and cumbersome to schedule, but worth it because drivers almost always showed up on time with a clean car and with a smile. Most big cities had a handful of these town car services, and they competed by making small incremental changes to their business model. One might provide a fresh copy of the local newspaper to differentiate themselves. The competitor would get wind of that the rival was offering, and they would provide a newspaper and a bottle of water for their passengers. This competitive environment incrementally pushed the industry forward in small, virtually imperceptible steps. Then along came Uber in 2009 with a step change improvement. Uber enabled busy executives to hail a town car instantly by using their mobile application. This was years before introducing UberX and its broader selection of vehicles and food delivery services. The in-car experience was similar to a town car experience, but Uber's offering was a step change improvement on a number of dimensions. One, since your credit card was preloaded into the app, there was no need to fumble with money or provide payment at the end of a journey. Your phone's mapping feature allowed you to see your car as it approached your location, reducing your anxiety about a late arrival. There was no need to book a car in advance, so you could save the hassle of a call and be flexible on your departure time. It all combined into a step change improvement into the experience of getting to the airport, and the cost a little less than scheduling a town car. It was a step change better value proposition than anything on the market. Today, Uber's market capitalization is measured in tens of billions of dollars, despite starting their business in the depths of the Great Recession. So we'll take this Uber step change improvement to a graph here and understand how Uber positioned themselves in the yes box. The alternatives for getting to the airport at the time included taking a taxi, public transit, a town car, or an Uber. Note that when the recession hit, customers didn't immediately gravitate to the cheapest option. In fact, Uber's launch offering was around 1.5 times more expensive than a taxi and a little less than a town car. Customers still wanted a quality experience, but needed it at a lower price. Isn't delivering a quality product at a lower price timely advice in any economy? Of course, but the difference in a recession is that your customers' inertia for doing things the way they have always done them gets disrupted. If you've ever taken your hands off your handlebars of your bike while traveling at a decent clip, you know all about inertia. It's the force that keeps you going in a straight line despite cross currents pushing you off course. The slower you go, the less inertia you have, and the more likely you are to fall. A recession disrupts your customers' inertia. Conveniences they rationalized in good times get scrutinized. Purchases that were made out of loyalty or sheer laziness are reevaluated. In good times, customers may stick with a supplier out of allegiance or ease because cash is less of a concern. However, as consumers start thinking about saving money and businesses start laying off people, your customers' bar for reevaluating suppliers goes down. Said another way, the economy worsens, the yes box gets bigger. Customers enter a recession with the heightened expectations associated with a lagging economy. They have come to enjoy, even expect, high quality. So the idea of compromising on a solution in the early stages of a recession feels like an unacceptable step down. As a recession grinds on and cash becomes even harder to come by, the willingness to accept an inferior solution and save money may increase. However, in the early days of a recession, customers will be looking for alternatives to give them a similar experience as they have come to enjoy in the good times at a lower overall price when combining both the hard and soft costs of completing the job they are hiring your product to do. A recession can be challenging to navigate, but a difficult economy can also present opportunities. Some of the most successful companies we have come to know and love, from Airbnb to Uber, MailChimp, were all started during a recession. While it may be tempting just to lower your prices to maintain sales, becoming a low-cost provider in your industry is a race to the bottom that nobody wins. Instead of playing defense, the most valuable companies go on the offensive during a recession through step change thinking. They target their customers' yes box by providing better overall product at a lower cost at a time when prospects are looking around for alternatives. I want to thank you for attending today and invite you to download the free ebook. Can be found in our website at the address on the screen. Our session today gave a good introduction into the Value Builder system and the core concept of the 8 drivers of business value. The S-Box presentation was one of the many available in the system to provide other ways of thinking about your business. As a Value Builder certified consultant, I can help with your business at a deeper level. Through an analysis of your business that starts with your completion of the questionnaire to get your Value Builder score, we can see where you are, but more importantly, work to get you where you want to be. Whether your plan is to continue your business for many years, or you are planning to transition out in the next couple of years, the time is now to start working on your business, which is likely your most valuable asset. We at our Tisi Professional would be happy to help you on this journey. We have 3 offerings for you to continue increasing the value of your business. One is for you to sign up on a do-it-yourself program, where for $99 per month plus applicable tax, you would get access to a monthly tutorial on one of the drivers that you can watch and then implement for yourself. The second program is where we meet monthly with a small group of other business owners, and I present and we discuss some of the drivers each month. The investment for this program is $375 plus tax per month, and it would start when we get enough owners to sign up for it. The third program is for you and I to meet individually each month to discuss whichever of the drivers is most important to your business at the time, and how we can analyze ways to increase the value of your business as it relates to that driver. The investment in this program is $1,500 per month plus tax. It must be emphasized that there will be effort on your part to benefit from this process, but we will be there to guide you along your way and walk with you through the journey. What we have on the screen here is the mastermind session that we're looking to start up in June. You can learn more about it and sign up for it at the link shown here. Everything in the Value Builder program starts with the Value Builder score. And if you go to my website, you can get your free Value Builder score by filling out the questionnaire. The resulting report gives you your Value Builder score. I'm going to go over this with you in a comprehensive report and a complimentary one-on-one session so we can see where you are. I'm sure you will be looking at the value of your business in a whole new way. Let's see what your score is, because what you can measure, you can manage.